Hi, my name is Max Haynes, and this is part two of using Google Finance in Google Sheets. You cannot actually use it in Excel because it's tied, needs to be connected to the internet, and Google Sheets allows it to do that and be able to use that function. The Google Finance function does not exist in Excel. But I was able to pull up together really quickly a way to use these stocks. So, what you're seeing right here on the far right, and this is a really good way to be able to create stock screeners and be able to kind of look at stocks really quickly. So, I have right here on the right, this is the price of those companies for the past 5 years in a spark line. So I can see kind of how these companies have performed. And then what I'm looking at here are mostly RITs. WMS, I believe, is Williams, which might be an oil and gas company. So is OKE. So companies are oil and gas companies, but most of these are REITs, which are real estate investment trust. But what these companies do, what this does here is it pulls up their price. I can see the current price of all of these, and then I can pull up their beta values. Beta is how well they coordinate to the stock market as a whole. So a beta of 1.88 means that if the whole stock market goes up 1%, they tend to go up. Not always, it's not a guarantee, but they tend to go up 1.8%. But the opposite is also true. It's a measure of volatility. So if the whole stock market went down 1%, they would go down 1.88%. So it's an important thing to consider on how volatile of a stock do you want here. I can see the year-to-date price change. Essentially, what I'm looking at that here is the price today lower than the price was a year ago. When I used this was right during a little bit after the coronavirus pandemic caused a steep drop in the prices. I wanted to find companies that had been doing really well before the pandemic, dropped off due to the pandemic and everyone getting scared, and then that I would buy into those companies, preferably at a cheaper price. And I was also looking for, so that's why I had this relative price here. Because I have their pre-COVID price and then their current price and their year-to-date change. And then I have their earnings per share, which is a good metric to follow as well. This is the volume. And then I have the dividend yield, which is really what I cared about. In this case, I was looking for companies with a really high dividend yield. And so still have that. And so then I was able to go through, narrow down these companies, figure out which ones I liked, which ones I didn't. I actually built a heat map. So you can see here, if the earnings per share was negative, I immediately eliminated those companies. If it was real negative, if it was a little bit negative, I still probably went ahead and eliminated them. Green means I liked it. So what I want to do is really quickly be able to look across and see, let me see how this company is doing. And so one of the ones I found here is OKE, which is Oniok. They are an oil and gas midstream company. They move around natural gas and crude oil. And so the way they work does, I was quickly able to see after I overlaid the heat map that this company is green on earnings per share. They have a good dividend yield. I was wanting a pretty high dividend yield. A 9% dividend yield was good. I was also able to see that I can see it in the spark line, but I can also see it on this relative price here and in the year-to-date price change. And so I was able to, at the time, be able to see, okay, so let me follow the line. They've had really good good performance all the way through. They've been steady, maybe even grown a little bit, all the while paying a really high dividend. Coronavirus hit and they fell really hard, but coronavirus didn't really affect their underlying business too much because we still need natural gas in order to heat our homes and things like that. And natural gas also long-term outlook, even though we are shifting to more and more renewables, natural gas is the middleman. It's the way that we shift from non-renewables to renewables. So I see in the next 10 to 15 years, natural gas still being really big. I did a little bit extra research on that industry, which is an important thing to do, is know the outlook of the industry. So I read the reports from Exxon, from Shell, and from Chevron and BP on what their 5 to 15-year plan looked like for the energy sector. And almost all of them showed a massive increase in the amount of natural gas that they would be producing. So those are the producers. Well, this is midstream. So midstream's not quite as volatile, but you can see it's definitely more volatile than the stock market as a whole. It has a 2 for a beta. So, it's going to move twice for 2% for every 1% the stock market does. But the nice thing here was it was midstream, so it wasn't quite as volatile, and they're moving around. So if the producers are producing more natural gas, they need Oniok to be able to send that natural gas and move it around. So I went ahead and bought into that company. I don't know where exactly, but around this area. And as you can see, it has increased since then. So it was a good idea. Still hasn't reached pre-COVID levels. It may never reach pre-COVID levels, but at the time it was a good buy, especially for the short term. And I liked it for the long term because it was paying a good dividend. So even if the price held constant, I was still making money, even though the price of the stock didn't necessarily go up. But this is a really good way that you could go ahead and use Excel to create a stock screener and find stocks that you like. So hopefully you learned something today, and best of luck.